What's going on, guys? It's Bandit FX, and in this video, we're going to be covering stop loss placement factors and risk management. Um, basically, this is how you're going to gauge where you're placing your stop loss in relation to your take profit. What are safe areas to place your stop loss, and not only safe areas, but strategic areas. I see a lot of traders using random stop losses that really don't make any sense, and then they wonder whether their stops getting hit more often than not, or their winners are much smaller than their losers. Um, let's talk about the four main factors of stop loss placement first, and then I'll go into each one individually. So you have structure, risk reward ratio, candle highs and lows, and Fibonacci if you are trading Fibonacci. So the first thing we're going to talk about is structure. Anytime you're taking a trade, you're going to want to protect your stop loss location with some sort of structure, like market structure, meaning support or resistance. So, for example, um, if we're going to place a short trade as price was coming up into this area, right? We had a resistance form up here, right at the top, right? Once you have that resistance formed and you get this big engulfing candle coming down, let's say this is your entry candle. Um, we're going to go ahead and put a short position right here. Where you're going to want to place your stop loss is, you're going to want to protect it with a resistance, right? Obviously, in order for your stop loss to get hit, it has to be above this resistance. So this is like kind of the first concept we're going to talk about. Um, is protecting your stop loss with like kind of a barrier, meaning market structure, whether that is a resistance level in a sell opportunity or a support level in a buy opportunity. We're going to go over basically a support level in this case right now. So we had this resistance formed right here as we were coming down. Price formed a support, formed a resistance, and then broke down further, and then we started to come back up. So right here, once we're breaking above that resistance, this would basically be your entry candle. Candles are breaking the highs of the previous ones, and so on and so forth. Let's say we take the long position. Our stop loss is going to be below, our most recent support. Um, this is, you know, it all depends. I mean, because it depends on the scenario, but um, a good thing to keep in mind, like obviously it doesn't have to be on the 4 hour. If we break this down to the 1 hour time frame, we do have, okay, perfect. We have a minor support level right here. You could even say this level because this is where they all kind of went through. You have this very minor support level here on the 1 hour time frame. Obviously, it's not as strong as the 4 hour support because we had a very strong bounce off this level. But the most recent support that had formed on lower time frames, such as the 1 hour in this case, is right here at 152, 126. So place your stop loss below that. Give your stop loss something to be protected by, as far as market structure. So those were two very simple examples. It's not a very hard concept to grasp. Just make sure that whenever you're taking a buy or sell, if you can, place your stop loss strategically, either above a resistance in a sell opportunity or below a support in a buy opportunity. Now, the second thing we're going to talk about is risk reward. Now, there's a lot of different ways people like to go about this. Typically, for me, because I do scalp a lot, I am looking for at least the bare minimum risk reward is a 1-to-1 ratio. A lot of people say 1.5 to 1, a lot of people say 2 to 1. 1-to-1 ratio will guarantee you that you are not risking more than you are attempting to make in that trade. So, yeah, I mean, and since we're going down this list right now, you guys are going to want to use as many of these as you can in conjunction with one another in order to make the trade obviously make most sense possible. So if you can get a 1-to-1 ratio and use a support or resistance as a barrier to protect your stop loss, um, that is something you're going to want to do. Let's see if we can find an example right here. Okay, perfect example. So we had, let's break this down, a 30-minute time frame. Where'd it go? Don't know. Oh, right here. Okay, so in this scenario, right, we had price come down here. We formed a support type of double bottom thing. um, right down here at this level. Now, there is, multiple wick rejections to the upside. That's not really what we're talking about here, but we're going to go ahead and draw this resistance because price was essentially ranging on a 15-minute time frame, right? So we have our support level. Obviously, there's a level in between here as well, but I'm not going to mark it because it's irrelevant to what we're talking about. Um, so we have the resistance, basically the top of the range. We have the bottom of the range right here as price was consolidating. Once you got this break and close above the range, and then this candle broke the high, that was your confirmation for your entry. Now, in this case, looking at a long position, right? We break the high, that's when we take our trade. Our stop loss is below the most recent support. To protect that stop loss, take a look to the left here. You have this candle coming all the way up, um, basically right at the peak of that candle. This is a 1-to-1 risk reward, and it is below the range. Now, there's two ways to play this, especially when trading, breakouts out of ranges. Um, One option is to put your stop loss below the support, like we just talked about. The other option is to put your stop loss somewhere back in the range, typically around the halfway point. That way, if this candle does close back in the range, the trade is no longer valid, and to manage your risk accordingly. In this case, it would be a 2-to-1 risk reward ratio. Obviously, we're looking left. We see that clean traffic. We know that price can continue upwards, and this trade does make sense. But yeah, the whole gist of it as far as risk reward is to make sure you at least have a 1-to-1 risk reward. If you do not, that is the key factor. Like if you have any trade set up that you're looking for a breakout, you're trying to catch whatever type of move, but your risk reward is not at least a 1-to-1 ratio. Um, Obviously, without placing a random stop loss, like you can't just have a random stop loss, for example, like up here. You know what I mean? To catch a 1-to-1 risk reward ratio, it doesn't make any sense. Um, the stop loss actually has to make sense. So if the stop loss makes sense and your risk reward ratio is not bigger than a 1-to-1, there is no trade setup. You never want to risk more than you are actually attempting to make on that trade. So your profit or your reward should always outweigh the risk or at least be equal. So, third thing we're going to talk about is candle highs and lows, and this is probably the most common form of it. Um, for example, we're going to use this example right here. We have a little resistance formed up here, very minor resistance on a 30-minute time frame at 151,800, and we have our most recent support level. I'm actually going to extend this a little bit more to the left because it did bounce off this level twice. Down here at 151,678. So obviously we're in an uptrend. Price is coming up. We broke above this previous wick. We're coming up here. We formed a support off of the previous resistance. Now, as candles break the high, providing there is clean traffic, which there is ample clean traffic in this case, where we're going to be placing that stop loss is below that breakout candle, right? So in this case, 30-minute time frame. This happened to be New York session. We have a lot of volume coming in. We're taking that trade as either, this could be an impulse entry as well because, this candle is coming up high volume session as well as, we're breaking. We had one bearish candle, we broke the high. So assuming we took the trade right here, because price isn't really ranging, this is just a simple retest as of right now. Once we break the high of this bearish candle, we're going to place our stop loss below the current bullish candle in a buy scenario. So this is the bottom wick right here at 151,678 on the bullish candle. Our stop loss is going to be right underneath that, a pip or two below it, and then we are going to obviously put our take profit in the according or the most relevant spot, which in this case would be at this resistance, and this would happen to be a 3.66 risk reward ratio. So in this case, you got all three factors right now. This is a very, very high probability setup. This is a very, very good trade right here because everything is playing into each other. So you have a resistance formed, we form a support. So now we're not only is our stop loss below the support level, we have that barrier, right? We're below the most current candle low. So this candle would have to come all the way back down and break its own low, or start breaking the lows of the previous candles in order to stop us out. So those are the two factors. Our risk reward ratio, if you're looking left, you see all this clean traffic. We have plenty of clean traffic to the left. A 3.5 R basically on this trade. So I mean, even if you entered on candle close, you know, even entering on candle close is almost a 2R, 1.75R. This would have been a beautiful trade. Now, the fourth thing I'm going to talk about is Fibonacci. Now, this is all depending on if you trade with fibs. I know some people do, some people don't. But this specific type of stop loss placement is what I like to use when I trade fibs. It's not the most aggressive way. I will show you the aggressive way and then the conservative way. But essentially what you're doing is you're giving yourself a 1-to-1 risk reward ratio in the conservative way to make sure that um, you have a very relevant stop loss. And what I mean by that is, if we're taking a look here at this fib, I'm just drawing it in this blank area just so you guys can see what I'm talking about. Let's say we take a long position. Now this has to be on the 618. Your entry has to be at this level. This is the golden zone, the 618. This only applies if you are taking the trade at this level, right? So if you take a look at this, you'll notice that the 236 and the full 100% retracement is a 1-to-1 risk reward ratio from the golden zone. So that means if you're taking a trade at the 618, your first take profit should be at the 236, and your stop loss should be at the full retracement. Now, why at the full retracement, and why not just below the 786 level? Because this level should be respected in theory. The reason that I like to do that is because, put it like this: if price is going to come back down, right, and go against you and stop you out here, that means that it's testing that low again, or it's going to create a lower low, right? Because you're basing this off the swing low. So if we break this level, price just made a lower low, it's no longer in an uptrend. Now, fibs work the best, or I mean, the only time I'd ever recommend using Fibonacci is when you are in a trending market. So in this case, it works great. So obviously, if we're in an uptrend and we break the previous low, we're no longer in an uptrend. That invalidates the entire thing. So you had a support level here, obviously, because this was the bottom of the swing. So the support level falls into falls into place. So we have that checked off. We have the 1-to-1 risk reward ratio. That's checked off. The candles, highs and lows. This really doesn't apply to Fibonacci, but most likely you'll see some rejections here at the 618 level, and then you'll see the continuation. But then you have what I was just talking about, the Fibonacci actually breaking the lower, creating a lower low, invalidates the fact that we were in an uptrend on that time frame. So that was the conservative version of this. The more aggressive version is putting your stop loss just under the 786, basically hoping that if price does come a little bit farther down in the drawdown against you, that the 786 is going to act as that barrier. It all just depends on the pair that you're trading. At the end of the day, you have to backtest whatever strategy you're using. There is no one strategy fits all pairs. If that was the case, everybody would be rich and everybody would trade every pair and make money on every pair, but that's not how it works. So depending on the pair you're trading, this may work more often than not. Some pairs you may find yourself, that pairs do have those liquidity grabs down to the 786 level, and you get stopped out more often than not. But the most conservative way to get that 1-to-1 risk reward ratio, bare minimum, very, very conservative Fibonacci entry, is bringing your stop loss down here to the full 100% retracement and keeping your first take profit at the 236. As far as managing this trade, right? If we get a candle close on whatever time frame your bias is, whatever you're taking this trade on, whichever time frame you are taking this trade on, if we get a candle to close below the 786, know that you have to close a percentage of the trade. Now, what do I mean by closing a percentage of the trade? What percentage? That's all relative to you. You know, what do you want to close in that area? Me personally, if price is coming down to the 786 level, I'm closing at the very least 50%. Obviously, it depends on the type of candle close. If we get a very, very bearish candle come down and close down here, halfway in the 786, I'm starting to think, okay, well, maybe this isn't valid anymore. If you start to see a lot of momentum, it all depends on the setup. If we start to get a lot of downwards momentum, say news release hits, something like that, and we do get that very, very strong bearish close in this range right here, I'm going to close more than 50%. Chances are I'm going to close about 80% because, I mean, technically the trade is still valid, right? Um, Technically, we're still in an uptrend. We haven't broken the low. We haven't made a newer low. Um, so the trade is still valid to some degree. If we do get a strong close, I'll probably close around 75% down here. That way, yes, it's a losing trade. Unfortunately, you lost a trade, but you're not going to lose the full risk, number one. And number two, you're not going to um, close the full amount down here because now if price does go in your favor, you're going to recoup some of that. You know, um, like I said again, like this is all preference depending on what you want to close. But I do recommend that if we get a candle close or a candle that breaks below the 786, or especially if it closes below the 786, that you're managing your risk and closing something. So let's take a look at this on a live example. Let me find a 618 pullback. This looks like a beautiful setup right here. Let's see. So we have the swing low, swing high. Yep, right off the 618. So if you take a look here, we're taking a long position right at the 618. Obviously, if you look at the lower time frames, hopefully I can go back that far and find it. Yep. Okay. So price came up. We had this full push up, and then let me move this over a little bit. We had the Morningstar pattern kind of form here. I mean, even if you didn't get in right here, you have multiple rejections in this area. So you take your entry at the 618. It's, you have the confluence of, hey, this was a previous resistance level. It's now turned support. It's been support in the past. This is a strong area of support. So this is where you're taking your entry. You're placing your stop loss in the conservative case, down at the full retracement, and your first take profit at the 236. Now, how much am I closing at the 236? Well, personally, when I get to this level, I'm closing 80% of the trade and I'm letting the runner run because the runner can make you a little bit more money. But what you want to look for when trading, especially when trading fibs and things like that, like you see these people hit all these crazy risk reward trades. You got to think like, how often does it happen? You know what I mean? Something you're gonna want to look for is consistency when trading. What can you hit consistently? I mean, this is just a baseline. If you notice that you're closing at the 236 level, and 9 times out of 10 you're making it at least to the full high, basically to retest that high, then by all means move your first take profit up here. But like I said, like I don't recommend doing that unless you have some sort of back testing. Um, you're not just going to want to randomly say, okay, well, my first take profit's going to be at the 272 extension, and you have no idea if it's even going to go that far. I can tell you 9 times out of 10, if you take a 618 entry and there's a support form, that you're at least going to that 236 mark, which means at the very least, if price doesn't just completely go through your entry, like form a support and then break right down to the full retracement and then create a lower low, that you're going to at least hit that first take profit. So this is what my 1-to-1 ratio would look like. I mean, obviously it's not perfect right now. Okay, so let me drag this down. Okay, so you have that 1-to-1 risk reward ratio. But this was the conservative way. Obviously, if you're taking a more aggressive entry, it's a little bit less of a stop loss. It's about 40% less, I want to say. But you know, you do have that higher chance of getting stopped out. See how deep these wicks came down to the 618 level. Um, when that happens, you can get tagged out. So you're going to see more. You're definitely going to see more losses um, using a more aggressive stop loss, but you may see a higher rate of return in terms of risk reward. So if you're risking, 1%, in this case, if you win the trade, you're making 1.85%. If you lose the trade, you're only losing one. So you only have to be right um, about 30% of the time or 35% of the time in order for you to break even with this case versus you having to be right 50% of the time in the conservative case. Um, but not necessarily because, like I said before, when we're managing our risk and we're closing partials when we're in drawdown, that brings your winners back in your favor. That brings that risk reward percentage back in your favor because you're mitigating the risk and you're closing, um, the losers early. You're closing your percentage of the losers early. You're taking that loss. You're not taking the full 1% loss. You may lose 1.5%. Or my bad. Instead of losing the 1%, you may lose 0.75%. You're losing basically 75% of that total risk that you had on the table. So, yeah, guys, that's the example of the fibs and kind of both scenarios, how they play out. Overall, you the whole gist of this is just to make sure that you guys are being able to line up as many of these as possible with each other. That way you get a more confident entry and you have a more confident stop loss placement. It's protected by stuff that makes sense. It's not just random. Like, oh, I need a 1-to-1 risk reward ratio. So, people just will literally enter something and be like, oh, my take profit's here. So for it to be a 1-to-1, my stop loss has to be this tight. Like, you don't fit the trade to the risk reward. You fit. I mean, wait. I don't. Well, let me say that again. You're not trying to fit the risk reward and the stop loss to make it a 1-to-1 with your trade setup that you see. You have to make sure that the trade setup that you see fits a 1-to-1 risk reward or better. All right. So with that being said, let's talk about risk management. We kind of already talked a little bit about it. We touched upon it when closing partials and drawdown on that fib example. But kind of when are you going to want to close partials? Well, there's mainly four reasons you're going to want to close partials. One of the reasons is when you see your percentage chance of success go down, like the probability of that trade being a winner, when that probability starts going down, that's when you're going to want to start closing partial positions. So for example, let's say I take an entry on a 30-minute time frame. Let's just kind of put a box here so I know where I'm at. Okay. So we take an entry on a 30-minute time frame right here on this candle, right? Now, if you take a look at the 15-minute candle, right? And that 15-minute candle starts, where did we go? Okay. This was that 30-minute candle right here. Actually no, it was this here and here. These two created that 30-minute candle. Now let me just draw this because it's gonna be the easiest way to do it. Okay. So let's say we get a small bullish candle form right here, right? So we have a little, why is that doing that? Okay. I might have to just draw this separate so you guys understand. But basically, when a candle low gets broken, actually this is a perfect example, right? So let's say you take a buy entry right here. You're trying to get to the top of this range. You see the candle high break, but the candle closes bearish. We didn't break the low, so candles are still trending upwards. However, now you have this newfound resistance. So one option for you to manage your risk is to close a percentage when this happens. Because, you took an entry in anticipation for price to move up, at least to this level, which is our next resistance. because obviously we had candles coming down. We broke the candle's previous high. We're starting to come up. We take the entry, right? With the candle close, strong bullish close, upper wick. Next candle breaks the high. Everything's looking good. But all of a sudden, this candle closes bearish. Now, you have this resistance here, okay? And if you look to the left, you'll see that this support right here kind of turned resistance. What are you going to do? I would recommend you close a percentage. Typically, when something like this happens, I'm closing 50%, right? So you close 50% of the trade, and then you let the rest run. That's kind of how it works. Obviously, if you get more indications that price is going to go against you, you can manage risk more, but typically I like to only close 50%. And the reason for that is sometimes you'll get faked out when this happens and price will run in your favor in this case. So let's say, let's pull out the profit loss calculator or tool right here. So we took the entry when the candle closed, we broke the high like we were talking about, right? We're trying to only hit this level. And then we have a runner and whatever. So let's put it at the top. Okay. So it's about a 1-to-1 risk reward, right? We're closing 50% right here. So we have a 17 pip stop loss. We close 50% once this candle closes at a 4.7 pip stop loss. So that's about what? 1, 2, 3. That's about a fourth. About a fourth of your total stop losses where um, you're closing 50%, right? So once you close that, now you only have a remaining 50% on the table, but what you lost was a quarter of your total risk, but half of that. So an eighth of your total risk. So let's say this is a 1%. I mean, let's just use round numbers to make this easy. So say we have a 16 pip stop loss, right? And we close 50% of it at 4 pips, right? You just closed it in 25% of drawdown. You're not at the full 100% drawdown like your complete stop loss. You close 50% at 25% of your drawdown. This means that you just took off the table and accepted 1/8 of that total risk is like a loss. So instead of you losing 1%, you're losing 1/8 of that. Now let's see what happens with the rest of the trade. Right, so you have a 16 pip stop loss, whatever. You let the rest run. Candle flies up, hits your take profit. Now what happened? 50% of that trade, you lost 4 pips. The other 50% of that trade, you made the 16 pips. Right? So you balance it out. Obviously, they're the same size. So 50% of it's 16 pips, 15% was negative 4 pips. You add them together. Overall, you made a 0.5%, or actually the full percent, times 12 pips. Right? So you made 12 pips on the trade. That is the benefit of managing your risk, because while yes, you could have caught the whole 16, but you could have taken the entire loss. And the number one rule when trading, and the number one thing you guys really have to focus on, is preserving capital. You cannot make any money trading if you don't have any capital left. And the lower your capital gets, the harder it is to make money. Because, I mean, I say this more often than not, like, you know, a lot of, like, one concept that people really don't understand is that, like, yeah, when you risk 2% and you win, the next trade you take, that 2% gets bigger. I mean, at least when you're using magic keys and it's a continuous 2%. I'm risking 2% of whatever my account balance is at that time, right? So when you lose a trade now and you lose 2% or 1% or whatever it is, when you go to take that next trade and you win, let's say you take a 2% loss, right? And then right after that you take a 2% win. That winner is actually smaller than the loser because you had just taken that full 2% loss, which lowered your account balance. And now when you're taking the next trade, that 2% is based on a smaller number. So it's harder to make money. So that's kind of one of the importances of managing your risk, especially when closing percentages when candles break. Now, In this example, we used it when we had a resistance formed, right? Another way to close is when you get a candle breaking the low, right, on a lower time frame. So in this case, it didn't happen, but let's say we had a bullish candle, another bullish candle, another bullish candle, and then we get this bearish candle. Now this is lower time frames, right? So let's just say that this is overall what that candle looks like, right? We got this big candle on, I don't know, the 15-minute time frame, and these are 5-minute candles, right? What happens is, this candle closes. If we get this candle to actually break the low and come down here, that's a break. That's a break and close. That's a lower low. That candle is now breaking the lows of the previous uptrending candles. Now, granted, this would be on the 5-minute time frame, so obviously it's not that strong of it's not really that strong of a case. But if this was higher time frames, such as you're looking at, you see two 15-minute candles on a 30-minute candle, and then the 15-minute candle breaks the low. This is typically when I see it happen the most. So I'm actually gonna change this for you guys. So we have two 15-minute candles here, creating this candle here to our left, and then the next candle that forms. So this is a 15-minute candle. I mean, this is a 30-minute candle. These are each 15-minute candles, right? This next candle, if it comes down here and breaks this low and closes lower, now this candle just broke the low. Like now these candles are no longer trending upwards. Like we have a resistance formed on the 15-minute time frame, and this candle just closed lower, meaning that there's a probability now that once this low gets broken, the candles are going to start trending downwards. It's going to invalidate the setup. So when this happens, this is another time I close 50% of my trade in drawdown. It's all about looking at the lower time frames to be able to see what's going to happen kind of like before it happens. You're trying to like foresee something happening. Okay, like, well, we're no longer making higher highs and higher lows on candles. We just made a lower low. We made a lower high, lower low on a 15-minute candle. Even though I took the trade on the 30-minute, this still has some significance, and I should manage my risk accordingly, because now at this point, there's a less of a probability that my trade is going to go in my favor. So this is when you're going to want to close a percentage of your trade, whatever it is. Like I said, I use 50%. You can close whatever you want, just whatever works for you. Um, but I think 50% is a good basis. So let's talk about the next thing. Lower time frame structure breaks is basically what we just talked about. News. So obviously, this goes without saying, but I just want to touch on it anyways. If you are in a trade, right, and there is a news release, whether it's scheduled or unscheduled, and you start to see all this volume come into the market and trade starts going against you, close the trade, close the whole trade. Do not sit and wait. You will get, you have the probability of getting slipped. And I've been slipped before, and it's not fun. And if you guys don't know what that is, it's your stop loss is right here. Price moves down so fast that it actually jumps over your stop loss, and the next time it ticks is when you get stopped out, and you actually get stopped out for an extra 5-6 pips. You know what I mean? That you normally would have gotten stopped out where your stop loss was placed. Um, One example, this happened to me, and I couldn't, honestly, it was like the worst luck ever. Um, but I was trading Asian session, and you know, Forex Factory was clear. There was no news release, nothing like that. Everything was fine. I entered a trade at 10:59 p.m. I was trading GJ at the time. Entered a trade at 10:59 p.m. Eastern time. So like right in the middle of Asian session. 1 minute later, like I didn't even have time to manage the risk. It happened so fast. 1 minute later, Bank of Japan announced that they were expecting or anticipating on raising their interest rates. Like this happened a few months ago to me. Like I literally could not believe it, because I entered a trade and it was a pretty decent looking trade, high probability, whatever. I was in the trade for 1 minute and just instantly got wrecked and slipped on my stop loss. So sometimes it's unavoidable, but good practice for whenever you're entering any kind of trade is know what news is up ahead, what can come out, and then if you start to see a big move, um, especially one that's like going against you, switch to Forex Factory real quick. I mean, a lot of people don't even know about this. We have calendar here, which is all the plan stuff. But when you click news, this is stuff that could be, non-scheduled, and they still do have the colored folders showing you the intensity of whatever it is. Let's see if we can find a red folder down here. Okay, gain in U.S. retail sales underscore solid steady consumer, whatever this is. Um, you could click it and read the article on whatever it's about. You know what I mean? It's on Bloomberg. Click it, read it. Hopefully you're a fast reader, but yeah, that's just something to be aware of. Now, another time that I like to manage my positions is when you start to see a candle rejection. So if, all right, this is a perfect scenario. Um, I wouldn't say perfect, but it's close enough to talk about. So we have this minor resistance. We have all this clean traffic to the left, right? Prices coming up. Let's say we're taking a buy entry. We're taking a buy entry as soon as this candle high gets broken, right? Because we had a resistance formed right here. This candle formed bullish, so now we have this newfound support, and that which was basically a previous resistance. And then we start, charging up or breaking the highs of the candles, right? So we take an entry at the break right here. Now, when you see, you're taking a long position, whatever, you got your stop loss below the most recent support, your take profit could be astronomical because, I mean, on the 15-minute time frame, there's all these clean candles. Beautiful trade. This looks like a great setup, right? We're coming into, actually, this is 5 o'clock, so ignore the time. This wasn't a high volume session, but let's say you took this trade. It was in a high volume session, everything like that. Price goes into profit. All of a sudden, before you know it, it's back at your entry and it starts getting rejected. Um, in this case, you have one of two options. Um, Playing it a little bit more on the safe side, which is something I do personally. Whenever I'm 60% on my way to a 1-to-1 risk reward ratio, let's just use a 10 pip example, just to make this easy. So we have a 10 pip stop loss, 10 pip take profit. If I'm 6 pips in profit, which is 60% of the way to my full take profit, and then price comes back, like as soon as I hit that point, 60% to my total target, that is when I'm moving my stop loss to break even. I mean, obviously, this is just something that I do personally, but it's something I would recommend somebody do, especially if they're trading, like if you're scalping, because I couldn't tell you more often than not, or I mean, not more often than not, but a lot of the times you'll see this happen. So you're in profit, you're 6 pips in profit, everything's looking good, you're approaching your take profit, all of a sudden price comes right back down, wicks all the way, like now you're in drawdown, right? And price closes bearish. Move your stop loss to break even to save yourself the headache. The other scenario is that if you get a rejection like this, even if it does close bullish, right, but a very weak bullish candle, um, I recommend closing 50% at least. Typically I'm going to close a little bit more depending on, how much of a rejection it is. But in this case, I'd be closing the full position. I mean, even though it worked out in my favor, but if I see this huge push up and then it gets absolutely rejected and then manages to close bearish, like this 15-minute candle is how big? It's almost an 11 pip candle, so it's a pretty decent size 15-minute candle. It's not a small candle by any means. For it to move this far and then get rejected right away and close bearish, that's telling you that there is a resistance, a very strong resistance here. So that's when I'd be closing the full position. I will just accept the loss at that fact or at that point, and just move on to the next trade. Even though in this case, if you would have let the whole thing run, obviously it would have went in your favor. But when you see such a strong rejection, that's kind of telling you that price is going to head the other way more often than not. Um, So we touched on rejections. We touched on the news. We talked about lower time frame structure breaks. We talked about candle highs and lows being broken. Um, okay, so basically, this is kind of what um, I talked about before. But when you're using this, is like moving back onto to Fibonacci again, or going back to Fibs. If you are trading Fibonacci, right? I mean, I kind of discussed this before. You're gonna want to close something at the 236 level. Yeah, we already talked about this. So, um, closing partials in profit. I mean, this is the other thing. Um, like I said, I like to close 80% at a 1-to-1 risk reward ratio. I like to close 80% of the trade when we hit that 236 on the fib. Um, Obviously, you don't have to do the same thing, but you got to remember um, you have to close more in profit than you do in drawdown, right? Because you have to make sure that those you're secure. You have to secure more on the winners than you do on the losers. I mean, as far as like um, distance goes, if that makes sense. So we have a 1-to-1 risk reward here. Um, if I'm closing at 80%, let's see, about 80%. Like if I'm closing 80% right here, right? That's 8 out of the 10 pips. We're just gonna assume this is 10 pips and 10 pips. Um, I'm closing 80% of the 10 pips. I'm closing at 8 pips profit. Now, if I close, if you let the full stop loss get hit, now you lost 10. So overall you're losing, right? If you close 80% here, I mean, you're breaking even, but in the examples that we talked about before, we get those lower time frame breaks. Say you get anything, if you're closing 80% or even 50, let's say even 50%, right? If you close 50% of that trade before the halfway mark in a drawdown, the most you can lose on that trade, even if the rest gets hit, is um, basically that. Say we're risking 1% on each side, you'd be making 0.8% if you had to take profit, or if you manage half the risk here, you're losing the 0.5%, and then the remainder is the other 0.5% times the full amount, which the most you can lose is 0.75%. So my rule of thumb is try to, at the very, very least, um, if it's coming in a drawdown and you're going over that halfway point of your stop loss, as long as it lines up with structure and you're starting to see some sort of a confirmation that the probability of the trade working out in your favor is going down, at least try to get 50% of it closed before you're halfway down in drawdown. That way, that, I mean, obviously, and this depends on what you're securing in your take profits. But this is for me. I close 80% um, up here, right? So, or what am I saying? At a 1-to-1 risk reward ratio. I don't know why I had that there. Um, so I'm closing 80% at the full take profit, right? But if I manage, if I close 50% down here, the most I can lose is 0.75% if the full thing gets hit. So this is making sure that regardless of either way price goes, if I win, it's going to outweigh the loser. Even though the risk reward ratio is 1, I'm closing 80% up here. So if price comes all the way up here, hits my take profit, and then reverses all the way back down to break even, right? I still made that 80% of the full risk, right? But if I close 50% in the halfway point and the other 50% gets closed down here, I'm only losing 0.75% of the total 1%. So that's why it's important that you're closing partials. Um, I don't know if I explained it very well, but it's very, very important because even though this risk reward ratio is 1, as long as you know how to manage losing trades and you could cut those losses and make those losses smaller and understand when you have a less probability of a trade working out in your favor, that you can, take some of that risk off the table and cut it short, that's automatically going to make your risk reward ratio higher because your loss is going to be smaller. So yeah, guys, that was um that was basically this video on stop loss placement factors and risk management overall. I threw a little bit of fibs in there. I know I usually don't talk about Fibonacci, but I know a lot of people are swing traders, and it can be applied to this as well. I do trade fibs also, just not very often, and I definitely do it on higher time frames when I'm not scalping. So let me know what you guys thought about this video. Please leave a like, leave a comment, let me know your thoughts, and if you haven't already, please subscribe. Um, the Bandit FX Discord is just about at 450 members. If you guys want to join, I'm going to leave a link below in the description. Just click it, accept the invite, and you guys will be in. We do trade ideas. We share them for New York session, Asian session, London session, and we have live streams every morning, 6:30 a.m. Eastern time. Feel free to drop your analysis in there. You'll have a couple people review them, things like that. Um, I do want to mention though, as soon as the YouTube hits 500 subscribers and the Discord hits 500 members, I am going to be hosting a giveaway where I'm going to be giving away, um, you know, I don't know how many of each, but definitely one Bandit FX course, and I will be giving away a few digital magic keys. So, if you haven't already, please subscribe, join the Discord. Let's get this giveaway started. But I will see you guys next time.